So that kind of brings us to the opportunities. And if you think about the opportunities out there, we've got them. The market is in a position where we believe, again, it's going to retrace, but it's up higher than anybody was really anticipating at this time. So when you're looking at investment strategies, and equally as important, the wealth enhancement, we're implementing strategies that are going to enhance your returns long term. So these are the 5 strategies that we've got ready to activate or have already initiated at this point. Over the next few weeks, we're actually going to highlight each one of these strategies. And this week, we're going to be looking at strategy 3, draw and let heal. So let's take a deep dive into this. If you have an investor who has a $500,000 investment, and prior to the stock market, they were thinking, hey, everything's going great. I've got 500,000 in the account, it keeps going up. And then all of a sudden we get this crisis. The account drops 20%. Well, at that point, a 20% loss brings them down to about $400,000 in the account. That's a decrease of $100,000. Now, if the account dropped $20,000, the question is, how much of a return do we need to get back to the previous level? Well, there's a calculation for that. It works like this. You take your value loss, you divide it by the current downturn value. In other words, what's the value in the account now? And then that equals the percent needed to break even. So in this equation, it's the $100,000 value loss. It's the 400,000 downturn value. So you divide the 100 by the 400, it means you need a 25% return. And some might be saying, well, wait a minute, it only went down 20%. Well, that's true, but we have less money in the account, so we need a greater return to get it back to even. It has to work a little bit harder getting back up to where you were before. So there's another question that comes out. What if you're taking income out of that portfolio during the downturn and the recovery? So it would not be uncommon for our clients to take, let's say, $5,000 a month out of the account. And if the downturn to recovery lasted 6 months, that's a $30,000 withdrawal amount out of the portfolio. Now, if you go back to the original equation, and that was your pre-cash value was $500,000, the account drops 20%. You now have $400,000, but you took out $30,000 from the account for your income. Well, that decreases the account to $130,000. So it's a lot less than it was if you weren't taking the income. So in this scenario, now we've got a $130,000 drop in the account. We divide that by the balance, 370. Now we actually need a 35.1% return to get back to even. You can start seeing that when you're pulling the money out, it's making it more and more difficult to get the returns back to where you wanted to be or where you were before. That is why in the 2008 crash, so many people outside of our office, so many people had such a difficult time getting back to even, and many of them didn't get back to even until 2015. Again, that was not the case with our clients, but you can see how if you didn't have a strategy in place like this, how much more difficult it is to get you where you want to go. Now, there is a question, well, I still need income. It's not like I can stop living, right? Well, we have a solution for that too. These are solutions that were put into place years ago for such a time as this. So what do we have here? We've got overfunded cash value in our life insurance policies. So that's one place to access it. Those who could not qualify or do not have a policy like that, we also have home equity lines of credit to access. To go even further, there are many clients that have cash in the bank that could be enough to sustain them through this crisis. That's where we want to be pulling the money. So if you do that and you left that $30,000 in your account, that $30,000, if we have a 25% rate of return, that's going to give you a $7,500 gain. So keep in mind, if you took the $30,000 out, you never would have gotten that gain back. And that's what's needed to help us get back without needing such a great rate of return. So I know I've got a lot of very, very intelligent clients out there. So some of you are asking this question: isn't there a cost associated to the cash value I have to pull out or the home equity line of credit? And the answer is yes, there is. But let's take a look at this. What if we took the $30,000 out of either of these programs, and let's just assume there was a 6% yield on those or interest rate on it for 6 months? Well, the cost of having that money out of those accounts would be about $1,096. Okay, let's take that and put it into the equation here. You have a $7,500 gain from the investments. You take away the amount of the cost to borrow the funds. That still leaves us with $6,400 net investor savings. So that's a big deal. That's more than a month's worth of income that the individual would have been taking out of the account. And I think anybody would say that makes a lot of sense. Let's take it a step further. What if you took that $6,400 and you got a 7% return over the next 20 years? Well, ultimately, that's going to give you about $23,000. Again, not chump change. Well, let's take it a step further. What if we have another 2 or 3 recessions? Well, 2 more recessions means that our net savings over time is going to be about $70,000. Again, that's a lot of money. That's what these strategies do for you. They enhance the returns to allow you to build and keep the money that you need for the future. So these strategies, do they take a little bit of work? Yes, they do, but I'm sure you can see that the money is well worth it, the returns. So that kind of brings us to our next slide. One of the things that we do these reviews for, or these weekly reviews for right now, are to give you updates on where we are in the strategies. So we do have some clients, some of you who are watching right now, that actually was doing a Roth conversion either prior to the market crash, or we actually executed somewhere on the way down. Well, at that point, we didn't pull any taxes out because with the market down, we did not want to do that. So right now, with the markets back up, we're actually going to pay the taxes on those Roth conversions at this point. Same thing is going to happen with life insurance. In other words, we suspended paying the life insurance premiums on any policy that needed to have a premium during this downturn. Now that the market's up, we're going to look back. We're going to grab every client that needs a premium paid. We're going to go ahead and make those payments this week and next week to get them up to date. So that's kind of an update on the strategy. We have not implemented any risk up strategies yet. Any cash that we have in the accounts right now that are waiting to be deployed when the market comes back, we haven't done that yet. We're still waiting for the right time. And same thing with all the Roth conversions that we have set and ready to go. They're just waiting for us to pull the trigger. So that gives you a little bit of an update of where we are today. So when we're talking about these reviews, our communication to you is key, and we want to make sure that we're assessing the situation, actively managing what we are doing for you and your accounts. You know, you need to be in the best position possible in order to ride out the storm and to be ready to capitalize on any kind of future opportunity. So that's what we're looking at. That's why we do these reviews. That's who we are.